kind of put forward here is keeping a level head. Sometimes doing nothing is the right thing to do. Well, it's an interesting day out on the market. Volatility is still here. We're starting to see that oil price tick up, and we've talked about this starting to form a bottom here from a technical analysis standpoint. Thanks to Gabe once again for the amazing charts and the amazing setups. But we're starting to see a W formation, a double bottom formulating here on recent crude oil prices. We were getting to pretty depressed prices here, trading under $66 a barrel. Now, if you're new to the channel, this is kind of an area we said at these prices you probably can hide out in, actually outperform the market, as volatility is definitely going to tick up towards the end of this year. And even though it is a fairly benign market when we look across, and we're seeing a tick up in oil, which we can equate to possibly more inflation coming down the road here. As this political tension is ticking up here and we're seeing oil prices tick up, we have multiple headwinds now that the Feds really can't fight off. We're going to see inflation on prices once again, and when we see oil prices picking up because of political tension, well, then there's double headwinds here as we have a slowing economy, as we have a labor market that could definitely be in question. So we did talk about oil as being an area where you might be able to hide out in. The energy sector, XLE is specifically where we pointed out is starting to form a breakout here. We can see the XLE hit a 1-year high of 97.99, basically around 85 to 88. We were recommending the XLE here. It has the same pattern formation as essentially crude oil does, has that W pattern formation. You were getting over a 3% dividend yield. You had good diversification in a fairly safe sector. When we look at the political tension taking place, it's a good place to kind of hide out in and wait for some things to settle. Window dressing for hedge fund managers when we talk about political tension and with possible inflation hedges and a Fed loosening policy here. As I stated, the market is definitely digesting things a little bit better than I anticipated. This is a very, very strong market, still in a bullish formation, but I would say the shorter term charts are starting to roll over here. But we see something like Conagra Brands take a 9% hit. Now, this is a stock that normally doesn't move a lot. Most of your returns are going to come in the form of a dividend when it comes to Conagra Brands, and the stock missed Q3 earnings, and the CEO is pointing out a challenging environment. This is one I believe I did an analysis on, and around $25, $26, it gets pretty interesting on this one. Now, with something like Conagra Brands selling off, you're going to see something like a Smucker's, ticker symbol SJM, a Hormel Foods, ticker symbol HRL. You're going to see some things like this sell off with the bad news that Conagra Brands came out with. And if you guys are new to the channel, between $100 to $105, I find Smucker's pretty interesting here. You'd be getting pretty close to a 4% dividend yield. This is a company that keeps raising its dividends, and I do think that this is a company, when we look at consumer staples, it's been a very, very tough macro environment for them to kind of manage. They're not really sexy companies to own, but I do think that there is some nice tailwinds going into the future. Consumers are going to have to do more shopping at home. Things are just getting too expensive. We're seeing the credit card debt piling up. And eventually, I do believe a lot of these companies will get their costs under control, and that's really where they're having the problems, is a slowing consumer and their high cost. It's a double headwind for these companies, but I do think they're getting pretty interesting to start owning. When we talk about, if you think we're in later cycle behavior, these are type of companies you can possibly hide out in if you get in at the right price. Of course, this is just all my opinion, but you guys can see here from a DCF model, we got Smucker's trading closer to $140 a share. And then from a multiple to EBITDA, I figure around $91 to $92 a share. So when I look at everything that's taking place, if crude oil keeps spiking, we have political tension, I'm really shocked at how well the market's digesting this. But if you guys remember what I've stated, it's a good time to start taking profits in this market, especially if we start breaking above newer highs, because I do think we're heading into a higher risk period. When we talk about mid to end of October is where I think we're going to see some crazy price action, and it's already started. And so when markets are getting crazy, there's a lot of political tension in there. If you're already in the market, there's nothing wrong with just sitting back, letting it cool off, build some cash, and figure out what the next move or opportunities are, and start running your models here and start looking at maybe some things that might be getting a little too oversold, or opportunities that are starting to present themselves that you didn't think were coming. Now, this recent fall from Humana to me is fairly interesting. This was over a $530 stock, now down to $236. The big catalyst to this move on Humana shares is the fact that the quality rating of the company has actually suffered, and this posed a massive threat to their revenue because quality definitely matters. Really hard to figure out the number that it's actually going to impact revenue here and how well they can recover from this. This is something I think I need to dig into, so that might be something I spend some time on, because this could be a pretty massive opportunity here, or it could be definitely a value trap as well. So that's something we have to kind of figure out for ourselves. And the other thing I want to point out here is the 10-year treasury is starting to creep back up here, which we have to start discounting stocks multiple ways. When we think about the macro environment right now, if we have a 10-year treasury kind of peaking up here, that definitely puts some downward pressure on stocks, or should put downward pressure on stocks from a fundamental standpoint. There's opportunities that present themselves that we didn't think were coming, and that's when we can start averaging into some things. So I would just say sometimes doing nothing is doing the right thing, even though every day we probably want to go in there, we want to buy the dip, we want to sell the rips, we want to buy calls, we want to sell puts or build into positions. And sometimes it's okay to just do nothing and let the cash accumulate for a few months until we get some clarity on exactly what's going on. And the other thing that happens is this gives you the opportunity to kind of really look at your portfolio and position yourself for the next 3 to 5 years on opportunities that could be presenting themselves. As I stated, I think this Humana sell-off is pretty interesting. I think you have some pretty interesting opportunities if consumer staples keep selling off. And I think when you look at a company like Nike, the whole turnaround story is pretty interesting on Nike as well. When you think more longer term and you keep getting that sell-off here, this is a name, that really was trading at 120, 130 bucks a share. Now was down to 70 at one point. So there's definitely some interesting names out there when you start thinking more longer term in these recent sell-offs that are taking place, that anything's really wrong here because the tech sector is really holding everything up. Now, if you're thinking that you're more mid-cycle, then you still want to stay in finances, you still want to stay in technology. But I've been saying it for the last year. I do think we're heading into late cycle, and it's been an extended late cycle because of the fact that there's a tremendous amount of stimulus through the economy, tremendous amount of liquidity pushed in, and that keeps the cycles lasting a little bit longer. That keeps the consumer's pocket well capitalized so they can keep spending. It allows technologies to have cleaner balance sheets, the higher interest rates they were able to take advantage of because of those clean balance sheets. But now that's kind of coming to an end as we're seeing short-term rates come down, and we're seeing the consumer really tap out here, which is telling me that we are heading into late cycle personally. Now, if you think opposite of that and you think we're more beginning to early cycle, which a lot of hedge fund managers are actually pushing on us right now, then you would obviously still want to stay heavily and overweight on financials and technology. Of course, I'm seeing these healthcare stocks kind of sell off here, and I'm thinking, well, that lines up well with pretty late cycle. Consumer staples are selling off. That's lining up well with late cycle as well. Are these some names that we kind of want to start looking at once again? And I know I brought up Pfizer a million times. I told you guys I think Conagra Brands between that $25, $26 range is a great area to kind of average in on. With Smucker's, SJM, once again, between 100 and 105. When we look at Pfizer, I think anything under $28 gets pretty interesting in this name. I have a price target between $27.50 and $28.15. So just call it $27.75 to about $28 is ideally where I like to accumulate shares of Pfizer. And Bristol Myers was one that I was kind of ringing the bell on here around $39, $40 a share. I thought it was an absolute risk versus reward steal at those levels. And you've had a tremendous rally, a rally that actually Pfizer hasn't been able to kind of catch up to. And I'm almost wondering, is Pfizer a good catch-up play when we look at all of healthcare kind of performing fairly well? And this one's definitely been a lagger. Is this one going to have a catch-up opportunity here? And I think there is a possible opportunity for Pfizer to catch up when we look at the consolidation here. And as always, really appreciate your time, and we will see you in the next one.